Ever felt like you're running on a financial treadmill? You're making payments, managing debt, but that big goal, like buying a house or consolidating high-interest debt, feels just out of reach. Often, the roadblock is understanding the credit score requirements for the loans that could actually help you. Today, we're diving deep into one such lender, LendKey, and figuring out exactly what kind of credit score you need to unlock their loan options. Let's be honest, credit scores can feel like a secret code. You know it's important, but the specifics can be murky. It's a 3-digit number that summarizes your credit history, basically telling lenders how reliable you are at paying back borrowed money. This number, ranging from 300 to 850, heavily influences whether you'll be approved for a loan and, importantly, what interest rate you'll be offered. A higher score translates to lower interest rates, saving you a substantial amount over the life of the loan. Before we jump into LendKey specifics, let's quickly recap the typical credit score ranges. Generally, a score below 600 is considered poor, making it difficult to qualify for most loans. Scores between 600 and 699 are often deemed fair, meaning you might qualify, but likely at higher interest rates. A score between 700 and 749 is generally considered good, opening up more options with better terms. Finally, a score of 750 or higher is excellent, positioning you for the best rates and loan terms available. Now, let's bring LendKey into the picture. LendKey is a unique lending platform. They don't directly issue loans. Instead, they partner with credit unions and community banks to offer a wider range of loan products, particularly in the student loan refinancing and private student loan space, and also offer home improvement loans. This network approach means that the specific credit score requirements can vary slightly depending on the individual lending partner. However, we can still outline some general guidelines. For student loan refinancing, LendKey's partners typically look for borrowers with a credit score in the mid to high 600s or higher. Ideally, a score in the 700s is preferred for the most competitive rates. This makes sense considering you are essentially replacing existing debt with a new loan, and lenders want to see a history of responsible debt management. This means consistently making on-time payments, keeping credit utilization low, and managing your credit history responsibly. For private student loans, the requirements can be slightly different. Since these loans are often taken out by younger individuals with limited credit history, lenders might consider other factors in addition to credit score. This could include things like your cosigner's creditworthiness, your current and projected income, and your overall debt-to-income ratio. However, having a solid credit score, even if it's not exceptionally high, can still be a significant advantage. It might also help secure lower interest rates compared to those without a strong credit history. Now, it is crucial to emphasize that a credit score is just one piece of the puzzle. Lenders also evaluate other financial factors. Your debt-to-income ratio, which compares your monthly debt payments to your gross monthly income, plays a significant role. A lower DTI indicates that you're not overextended with debt, making you a more attractive borrower. Lenders typically prefer a DTI below 43%, but ideally, it's even lower. Employment history and income stability are also considered. Lenders want assurance that you have a consistent source of income to repay the loan. A stable job history spanning several years often demonstrates financial stability. Another important aspect is your credit history itself. This goes beyond just the 3-digit score. Lenders look into the length of your credit history, the types of credit accounts you have, credit cards, loans, etc., and any negative marks such as late payments, bankruptcies, or collections. A long and positive credit history signifies responsible financial behavior. So, how can you improve your chances of qualifying for a LendKey loan? First and foremost, check your credit report. You can obtain a free credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, annually. This allows you to identify any errors or discrepancies that might be affecting your score. If you find errors, dispute them with the credit bureau. Correcting inaccuracies can lead to a significant improvement in your score. Secondly, make on-time payments on all your bills. Payment history is the most significant factor influencing your credit score. Even one late payment can have a negative impact. Set up automatic payments or reminders to ensure you never miss a due date. Keep your credit utilization low. This refers to the amount of credit you're using compared to your total available credit. For example, if you have a credit card with a $1,000 limit and you have a balance of $300, your credit utilization is 30%. Aim to keep your utilization below 30%, ideally even lower, as higher utilization can negatively affect your score. Avoid opening multiple new credit accounts in a short period. Each new account triggers a hard inquiry on your credit report, which can temporarily lower your score. Spreading out your credit applications can minimize this impact. Finally, be patient. Building good credit takes time and consistent effort. There are no quick fixes or shortcuts. Focus on establishing positive financial habits, and your credit score will gradually improve. To recap, while LendKey themselves don't set specific cutoff scores, their partnering lenders generally prefer borrowers with credit scores in the mid to high 600s or higher, with scores in the 700s opening doors to the most favorable terms, especially for student loan refinancing. Remember, it's not just about the score itself. Lenders analyze your overall financial profile, encompassing your DTI, employment history, and credit report. Understanding these requirements gives you a much clearer idea of what you need to focus on to get the best possible loan terms. If your credit score needs some work, don't be discouraged. Focus on implementing the strategies we've discussed, and you'll be on your way to achieving your financial goals. With that said, thanks for watching, and until next time.